Director of Derivatives Analysis, and Kevin's a Senior Investment Strategist. So we've got a big day tomorrow. Kevin, start us off here, as it seems like we just took a little breather after yesterday's rip-roaring session. Do we have potential for some movement tomorrow on this jobs data?
Yeah, but I think, as always, as is always the case with jobs, it probably matters more if you have some big surprise to the upside or the downside. So if you come in line with estimates, consensus is right around, I think, the 180, the 190 mark for payrolls. If you have an unchanged unemployment rate, average hourly earnings comes in as expected, and maybe more importantly, the breadth of gains is still relatively healthy. I'm not sure, you get as much of a move in the market. But, of course, we'll have to see what the reaction function is on the part of the market in terms of expectations for Fed policy, but also, the broader corroborating evidence that we've gotten this week so far, which is so far, more of what we've seen over the past year and a half, 2 years, which is relative weakness on the manufacturing side, offset by relative strength on the services side. And then you throw into that what I think was probably the most important data point so far this week, obviously not going to take more importance than tomorrow's jobs report, but the revisions for unit labor costs and productivity this morning, which were much more favorable, especially when you look at unit labor cost growth still running hot, but coming down from the initial estimate and being more consistent with disinflation for core PCE or core CPI.
Yeah, good point. Kind of a good disinflation print that's snuck in there today. Nate, VIX pretty calm. I mean, it seems like we've got an opportunity here for vol traders either way. I mean, it's just maybe complacent, one could argue, maybe appropriate. I mean, if we are going to thread that needle.
Yeah, I mean, at 12, you look at, obviously a 16 is a 1% move on a daily basis, one way or the other. Being at 12, that's been basically the low end of the range. S&P closes at all-time high yesterday. Areas of the market are stretched. Maybe you look at some protection or collars there. Semiconductors, 5% yesterday, they were up. That just kind of gives you a sense of some of the risk appetite out there, couple in Bitcoin near all-time highs and GameStop and the like.
Right.
As we get beyond this 10-for-1 split with NVIDIA, and as we get beyond the Worldwide Developers Conference next week, we could have, perhaps a lack of catalyst. Now, momentum could take us higher just because, technically speaking, yes, it's bullish to be closing at all-time highs for the S&P, NASDAQ 100, and the composite. But I think you just need to respect that. NVIDIA pulled back 20% plus from mid-March to mid-April. And these kind of pullbacks can happen, especially when you're doing this kind of a move in parabolic fashion. So in the semis and the tech space, maybe a little bit cautious as we get to the back half of next week.
Okay. To your point, it's getting a little bit frothy out there. The GameStop stuff. The last, 15% of NVIDIA has been valuation move, as opposed to what we got in the first quarter, which was a much more measured move. Kevin, do you think folks are once again prognosticating about the Fed and the cut timeline? Because everyone else seems ready to cut. Think the market's getting a little projection, a little jealousy of the ECB and the Bank of Canada?
I'm not sure how much jealousy there is, especially when the ECB didn't really lay out any sort of forward path and didn't pre-commit to anything. So for now, it's a one-cut wonder in terms of the ECB. So I think, it remains to be seen. But I for the broader market, Nate mentions sort of, I think, a good point of the index is moving higher, the cap-weighted index is moving higher, making all-time highs yesterday. But even with some of these pullbacks at times, whether it's a name like NVIDIA or any other larger stock, the important thing to keep in mind is that even though you've had cap-weighted indexes doing better since the mid-April low, even this year, there has been more deterioration under the surface. You've actually started to see a much more meaningful pickup in the percentage of members in the NASDAQ 100 that have entered their own bear markets. So not the NASDAQ with thousands of stocks, but specifically the NASDAQ 100, which is typically considered that, higher quality, large cap growth trade. You have seen more members in there enter their own bear market territory. The good news, I think, is that it hasn't really filtered over to the S&P 500, kind of the more traditional part of the market, or the broader part of the market. But I think that that's a maybe more technical warning worth mentioning, especially because you've seen the steady deterioration in breadth as we've gone throughout this year.
My shorthand for a lot of that is the Russell. Watching that thing as kind of our benchmark for lower quality and maybe a little Fed dependency, general breadth weakness. It just keeps getting rejected at that 21. And it's
although the one thing, just to jump really quick though, if you break the Russell even into zombies versus non-zombies, quality versus low quality, the non-zombies or the earners in the Russell have been doing quite well. They're up by over 20% since the beginning of 2023. So if you're screening for quality in a so-called low quality index, you could still find some gems. It's just not going to get picked up at the broader index level.
Right, not enough to outweigh it. Kind of the point, right? Is that's still one that needs a little help on the broad kind of macro strokes, which is why I watch it tomorrow, to see if maybe we get a little life in some of the other stuff. The last point on vol real quick, Nate, is that when we get Friday moves too, it starts to get interesting because if everybody gets bulled up and we start ripping calls and stuff, you could get that VIX up, stocks up situation.
Yeah, and we've seen, some of that call activity really picking up, some of the skew kind of tilt to the call side as well. So it gives you evidence that is showing up. Having said that, in the summer months, generally the VIX tends to come down because of the summer doldrums, so to speak. We are in an election year. June is not without its history of volatility. It is not a great performing month over the last 20 years. So yes, volatility can enter the equation. I just find it really hard to believe that we're ready to rip from a 21 forward PE to a 22, for example, if we begin to get, a non-farm payrolls that comes in a little bit light and some more lighter data on the table. Earlier in this week, we were having the narrative that there was more weight on the weaker economic growth or the contraction, more emphasis there rather than rates falling. This midweek, it changed and they went back and decided to say, no, actually rates falling is a good thing. That's not off the table. If we start contracting too much, watch out. We can get some kind of a reset there around expectations.
All right. Great stuff, guys. Love the details on the data. Love the analysis on the options. Great stuff. Kevin Gordon, Nate Peterson. Appreciate your team.